So, you're ready to start investing in India. Awesome! But right away, you hit this massive fork in the road, right? Do you jump into the exciting, high-stakes world of direct stocks, or do you take the slow and steady, disciplined route with SIPs? It is a huge first decision, and today, we're going to break it all down so you can make a choice that's right for you.
I mean, you see it everywhere. On one side, you've got the incredible pull of direct stocks, that dream of picking the next big thing, the next multi-bagger you hear about online. And on the other side, well, you've got the quiet, almost boring power of a systematic investment plan, or SIP. For a young professional just starting out, this is way more than just about money. It's choosing between two totally different mindsets about how you build wealth.
All right, let's get right into it. First things first, we need to make sure we're all speaking the same language. What are we actually talking about when we say direct stocks versus SIPs? Let's get these two paths clearly defined.
Okay, so buying a direct stock is pretty straightforward. You're literally buying a tiny piece of a company. You become a part owner, which is, really cool. Your financial success is directly tied to that company's success. But, and this is a big but, the opposite is also true. Your money is completely exposed if that company fails. The pressure is all on you to pick the winners.
Now here's a key point. A SIP isn't an investment itself. It's a way of investing. Think of it like a discipline tool. It's a system where you put a fixed amount of money, say every single month, into a mutual fund. And a mutual fund is just a big basket of many different stocks, all picked and managed for you by a professional. You're basically putting your investing on autopilot into a diversified portfolio.
So, now we know the two contenders. Let's throw them in the ring for the ultimate investment showdown. We're going to compare them side by side on the things that really matter for a beginner. We're talking risk, potential returns, how much time you need, and the kind of know-how you need to actually succeed.
This table, honestly, tells you almost everything you need to know. Just look at the SIP column. The risk is lower, it doesn't take much of your time, but in return, you're looking at more moderate, stable returns. Now glance over at direct stocks. Yep, the potential for high returns is there, but it comes with a seriously high price. High risk, a huge time commitment, and you've got to know what you're doing. It just proved that old saying, there really is no free lunch in investing.
Let's talk a little more about risk, because this is crucial. The secret sauce of a mutual fund SIP is something called diversification. You're invested in dozens, maybe hundreds of companies, so if one of them has a terrible year, it doesn't sink your whole portfolio. It's like a built-in safety net. Direct stock investing? It's the exact opposite. It's all your eggs in one or two baskets. If one of those companies hits a rough patch, you feel all of that pain. And maybe even more important, SIPs help you fight your own worst enemy as an investor, your emotions. By making it automatic, you avoid the #1 beginner mistake of panic selling when the market dips or getting too greedy when it's high.
And this really puts things into perspective. Study after study, including data from CB, shows that fewer than 10% of individual investors in India, that's people like you and me, actually managed to beat the market index, like the Nifty, over a couple of years. So the odds of you outsmarting the pros by picking stocks, well, they are heavily, heavily stacked against you.
So if trying to find that one winning stock is a losing game for most people, what's the alternative? It's harnessing this incredible concept right here, the power of compounding. This is the true secret weapon for building wealth. It's where your money starts making its own money. And SIPs, with their discipline and consistency, are the perfect vehicle to put this magical power to work for you.
Let's make this real. Look at this example of compounding in action. Say you start investing just 5,000 rupees a month when you're 25. By the time you're 60, that could grow to over 1 crore rupees. But check this out. If you wait until you're 40 to start that exact same investment, you end up with only around 33 lakhs. That huge gap? That's not a math error. That is the sheer magic of compounding. Your single greatest asset as an investor isn't money, it's time.
Now you might be sitting there thinking, okay, so I have to choose one or the other? But what if I told you that you don't? What if there's a smart way to get the stability of SIPs and the excitement of picking stocks? Well, there is. Let's talk about a pro strategy called the core satellite approach. The whole idea here is actually pretty simple, but it's incredibly powerful. You dedicate the big chunk of your portfolio, let's say about 70%, to a stable core. This is your foundation for long-term wealth. Then, the smaller remaining part, around 30%, becomes your satellite. This is where you can experiment a little and take on some calculated risk. The really important thing to get here is that each part has a very specific job to do.
Think of your core, which is funded by those disciplined SIPs, as the stable, powerful engine of your portfolio that just quietly chugs along, compounding your wealth year after year. Your satellite, on the other hand, that's your learning sandbox. This is where you can pick a few individual stocks that you've researched and really believe in. It lets you scratch that itch for direct investing, but you're doing it in a controlled way that doesn't put your primary financial future at risk.
All right, we've covered the strategy. Let's move on to the practical stuff. We're going to quickly touch on how taxes work for this in India, and then we'll wrap it all up with the biggest takeaways from our discussion.
You know, the tax rules for both stocks and mutual funds in India actually tell a very clear story. If you sell within a year, your profit is called a short-term capital gain, and it gets taxed at a pretty high rate of 20%. But if you just hold on for more than a year, it becomes a long-term capital gain, and the tax rate is much, much lower. The message from the taxman is loud and clear. They are actively rewarding you for being a long-term investor, not a short-term trader.
So after looking at all of this, what's the final verdict? Well, for almost every single person just starting out, the evidence is overwhelming. You should start with SIPs. It's not just about playing it safe. It's about building the right habits from the very beginning. Discipline, patience, consistency. These are the real cornerstones of building wealth, and SIPs forced you to learn them from day one.
I really want to leave you with this thought. It's so easy to think that the stock market is all about fast moves and chasing excitement. But real, lasting wealth, it's not built that way. It's built by embracing that quiet, almost boring rhythm of investing systematically, month after month, year after year.
So there you have it. We've laid out the definitions, the data, the strategies. You now have the map. The only question left is, what's your first step going to be? Thanks so much for tuning in.